The following is a presentation of TFNN. Trade what you see with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. Well, I think I've finally beaten that 5 weeks of hoarseness and nagging cough that I had. That seems to be getting a little better. I'm going to walk through some charts today. The first one I put up here, of course, is that long-term New York Stock Exchange Index chart, and I want to go through that. But first, I wanted to explain to you how I got started in this charting. It was I think it was 1960. Back in Indiana, the gentleman that taught me statistics, Jim Noblet, was a PhD from Yale, and it was his first teaching assignment, and his office was just filled with charts of Montgomery Ward and Chrysler and IBM, wheat and corn, and a couple of others. And then he was also big into poetry and stuff, and he said that this is how he made his money was by speculating in the market, and he believed that these charts were the things that told him where prices were going to go. And over the years, he sort of befriended me, and that's how I got started into the process of charting and all that stuff. So I just wanted to go through a couple charts here, and the reason why I say that, one of his favorite quotes was a quote by Henry David Thoreau about the if you're listening to the sound of a drummer and everybody else is hearing a different tune, you're probably listening to the wrong sound. That's basically what it amounts to. So I don't know if I'm crazy or not, but what I'm seeing is so clear that it's very, very clear to me, and unfortunately, I'm the only one that sees it. So we'll see. I'm going to share with you, what I've looked at, because over the last couple of weeks, I've had a lot of time on my hands since I haven't had to do the show or anything, and I've done more charts than I probably ever did in the last 5 or 6 years for sure. That's for sure. But anyway, we'll start out with this big chart here, the New York Stock Exchange Index going back 15 years. And you'll notice that when we had these major tops that were here, we have this 1, 2, 3, 4, 5 expanding triangle, which is, as we know from Gartley's book, one of the most accurate and also one of the most bearish patterns that you could possibly have, when you're doing these when you're doing charts like this. So that's what we want to focus on this morning. Now, the next chart that I want to focus on was brought to us by my good friend and trading partner, Jim Bartolioni, and this is going to show you the same chart, only what it's going to do is it's going to take you to the time frame of 2007 and where we are right now. This is the weekly chart, and as you can see by the arrows or the red lines on the bottom, that we have this divergence that's going on, and you'll notice that we have the same divergence that's going on right now. And if you'll look at the retracements from in 2007, you'll notice that it was making a 61% retracement. And again, what's happened is we've made another one at the 61% retracement. Now, this might be a coincidence. It certainly could be, but, maybe it's not. So you want to pay particular attention, to this, because it's a pattern that repeats itself not only with the divergence that you're having, but it's a perfect, 61% retracement coming back. We only spent 2 hours above the 61% retracement in the New York Stock Exchange last week. It was a 2-hour time period that the market stayed above the 61% retracement, and here we're talking about 0.001% of the exact number. So I think this is important. The other thing that's important is if you look at that ABCD pattern that we had in the New York Stock Exchange Index, you'll see that we had a perfect ABCD where the CD leg was exactly a 1.27 expansion of the AB leg. In other words, the CD was 0.27 higher than the AB leg, which fits it nice with the geometry. Whether any of this is going to work or not, I don't know. But all I can tell you is, be able to see what it is. Yes, Bart is a retired Navy pilot. I actually had the whole crew as my students. I have Rooster. He was the man who was the lead. He was the Top Gun pilot. I had Bucky, who runs the Kuwaiti Air Force. He trades out of Kuwait. And I have Bart, and then I have Jim is out of Ohio, and he was also in the group. So I had all four of them as my students, one at a time over the years, and I'm still in contact with all of them. Just really nice guys and exceptional people, besides being, good friends and stuff. So anyway, we'll get back to the charts here a little bit. So you see that this is a pattern that is repeated over and over again, so we should pay attention to it. And the reason why is, folks, I went over every single stock in the Dow. I went over all the major stocks in the Nasdaq, and then also the S&P 500. The S&P 500, 250 of the stocks in the S&P 500 are below the 200-day moving average, and that's a pretty negative sign in my opinion. And what's happening is that it's only about 120 stocks. It's not actually. It's about 120 stocks. If you look at the stocks in the S&P and the 15 big stocks in the Nasdaq, and then the Dow stocks, and the Dow is a weighted average. So, triple-digit stocks like Disney and Nike and Goldman Sachs and IBM. Well, the IBM's not doing too well, but the other ones that are, the triple-digit ones are keeping the market higher. And so that's another reason to take a look at that. If we were to go through, and we've had some big moves in these things, and they've left huge gaps. And the one thing that we do know is that these gaps are going to be filled. We'll take a first one. We'll look at Microsoft, because it exceeded the level that I assumed that it was going to stop at. I thought it was going to stop around the 154 level, and we got up to 150, 155 on Friday. But with that huge gap that we have from the earnings report that came out with that perfect storm we had on October the 23rd, that's telling us that it's probably going to go higher, but it will fill that gap. It's a question of when. The next one we want to take a look at is Google, of course, and here's another one. Here's another stock in the Nasdaq, and remember, the Nasdaq is a cap weighted, so the price of the stock along with the cap shares is what makes it move. And you'll see that it's also left huge gaps and is completing large ABCD patterns. I went through every single one of these, and they're all making major pattern reversals. At least they could be reversals. And believe me, I don't know if it's going to reverse or not. All I know is that there's some real serious stuff that I see happening, and probably don't mean much, but we'll see. The next one we'll take a look at here is Apple. And as you can see with the Apple, we stopped on last Wednesday. We stopped at the exact 786 retracement of the high of Apple from way back on July 20th. So that's an important thing. The other one that looked interesting last night, or watching the charts, and is the the New York stock, the NASDAQ. Let me get this up here a little bit. Oh dear, I'm starting to get hoarse again. Hold on. If you'll notice that in the NASDAQ, from July 20th until August the 24th was 25 trading days. We were basically, straight down. And then from the September 28th, when we had the super full moon, if you'll remember, the market had 25 trading days straight up, and that was done on last Wednesday. And the market has not exceeded that high as of yet. Whether that has any significance or not, I'm not sure of, but I'm looking at the New York Stock Exchange Index, because that's the one that really determines what the market is doing. That's the major one as far as the the biggest index. And what's really strange about it is it doesn't have futures against it, which all the others do. And that's always wonder what we're looking at. So we see that the 30-year bond is also going lower. Folks, anybody that doesn't believe that the interest rates are going higher, you're being very naive. All you have to do is look at those, notes and bonds, and you can see that they're going a lot lower. And this is what I think will happen is after I'll post this chart of the notes in here first to take a look, and then we'll look at the bonds too. But we are after we get to this increase, whenever it's going to come, and if the Federal Reserve does not increase rates with the market where it is right now, there's something bigger out there that's real scary. That's the way I look at it. I don't know what it'll be, but they have every beautiful thing that they could ask for with the market way up in the air, and it's just and not only that, but the dollar being really strong. All of that tells you that that's a possibility of something really big happening here in these interest rates. But it looks to me that once this is over, in other words, once they announce that quarter-point rise, then we'll see what happens. Folks, you got to remember too that the Federal Reserve, they don't have your back, folks. It's a private bank for bankers. And if you don't believe that, go back and look at the history of it. And you'll see that it's not a government organization, even though the Federal Reserve is on Pennsylvania Avenue, and it says federal. It has nothing to do with the government. They supply our money supply, which a lot of people like President Kennedy didn't think that was the right thing to do. And about 12 months after that, he was no longer with us. So you've got to be careful here with some of these things. Now, I wanted to share a chart that also a warning of some potential, overbought condition in the stock market, and that comes from our friend John Murphy. And if you'll take a look at this, you'll see what's happening here is that we have an overbought situation that we haven't seen for almost 9 months, and but this is not what the real market is doing. The real market is only making a 61% retracement of the whole move, just like we did in 2007, and it took 2 months to get it done. That's the way I see it. So anyway, we'll see what happens here, what's going on. We've got a new moon coming in on the 11th, which is Veterans Day, and I certainly hope all of you try to do something nice for veterans, because they protect us, they serve us, and they get virtually nothing, which is not a good thing. I think we really need to get some legislation change to take care of our servicemen a whole lot better than they're taken care of. So that's just my 2 cents worth. I'm going to cover some of take a little break here. 877-927-6648.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and I wanted to share a few of these other charts that I went through. The next one we're looking at is McDonald's, also a triple-digit mover in the Dow. And as you can see, we have made a 1.618 expansion of the range of last year. We're also completing the 1, 2, 3, 4, 5 expanding triangle. That doesn't mean it can't go higher. I'm just saying the pattern is there. Whether that's going to mean very much or not, we'll have to wait and see. The next one we're going to take a look at, of course, is Facebook. Here's another one that is a really big ABCD pattern that you'll be able to see that went up to the 109 level. We've left, in fact, that was a perfect ABCD off of the range from August 24th. But, whether it's going to continue from this level or not, I'm sure. We've already looked at Apple, and we'll be able to see. Someone asked me a question, who's the most bullish person do you work with or talk to? Do you mean, I don't know if you mean currently right now? If that's the case, I believe it would be Larry Williams. Larry Williams believes we're over a very high level, low level this week. In other words, the low that will come in this week, I'm going to try to get him on, yes, but he's very difficult. Well, he's a wonderful guy, but he's got so much going on that it's it's really good. So anyway, yes, there's a bull bear debate, and the bulls are certainly right here, and that's all I'm trying to do is to show you what I'm seeing. That's all I know. I don't I don't know any more than these charts. I don't profess to, never have, and I certainly don't want to change it or not. But I'm just saying that all these charts that I'm looking at, there's so many of them that are completing these patterns, and not only that, they're completing it with these huge gaps. And if you go look, just prove it to yourself. Go look about just go look at the pictures of the charts and go back to see how many gaps are not filled. You'll almost never find a gap that's not filled. There are just so few of them that it's really it's an amazing thing. Now we have another big gap in the banking index. It gapped up a little bit, not as much as some of the others, but Goldman Sachs had a huge gap up and stopping, went right to the 786 retracement. So I'm not sure. All I'm telling you is you look at all of these charts, whether it's Microsoft, McDonald's, Facebook, Google, they're just Amazon. They're all have these monster gaps up here, and they do look very, very bullish. But if you look at the New York Stock Exchange Index, it's not telling you that. So we'll have to, let the market tell us, and it certainly does. Now, if we look at the divergence that we're having, we're also having a big divergence in the Dow Jones Transportation, and of course, a really big divergence has been in the Dow Jones Utilities, because when we had we talked about these equal rallies that we had just a few weeks ago when they were occurring. And you'll see the market has broken down, and that's mainly because of the Dow Jones Utilities are so much confirmed that they are related to the interest rates, because utilities pay interest rate premiums on their stock, and these are very, very closely watched. So there's another reason to tell us that rates are coming. They are going to go higher. It's just a question of when. And remember, folks, we haven't. This is so unusual, because usually we are in a 4.5-year business cycle. That's been I think it was the Wheeler business cycle going back into the 1800s, and that stood for many, many years up until we came into 2009, and we were exposed in 2011 to quantitative easing, which is the experiment that the Federal Reserve has shown us, and it has made stock prices go higher. I don't think there's any question. It's made real estate prices go higher, and it has turned the economy around somewhat, which is good. How they're going to work out of this is going to be an interesting thing. I never could figure out how they did this, but I don't really know. All I'm saying is it looks a little strange when we look at these. We're going to have another break here in just a minute. 877-927-6648, and we will bring in the gold and silver. We need to talk about that, and we also need to talk about the foreign markets, like the Chinese market and the emerging markets, because there's been a lot of news about the new bull market in China, and the charts again are not really saying that. Now, it was up strong today in China because the Chinese government are going to allow IPOs again. Okay, 877-927-6664. We'll be right back after the stocks open.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization optimization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're looking for a great opportunity to diversify your financial portfolio and hedge against the falling stock market, consider the new market-safe Metals Hedge CD from Everbank. This 5-year indexed U.S. dollar-denominated CD gives you exposure to metals with gold and silver components and allows you to hedge against falling equities with a short component on the SPY ETF. You can earn up to 45% capped upside payment at maturity if gold and silver increase in value and the SPY ETF decreases across annual pricing dates. And should the opposite occur, your principal is 100% protected. Keep in mind, returns are based on CD performance. There is no annual percentage yield or periodic rate of interest on the CD. Don't let fallen markets get you down. Get the Metals Hedge CD. The November 12th funding deadline is quickly approaching, so hurry over to everbank.com/TFNN for the CD's term sheet and other important product details and disclosures. Once again, that's everbank.com/TFNN. This is sponsored content. Everbank is a member FDIC.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we have the stock market opening a little bit earlier today. I've also had a request to put a chart in for our good friend Priceline Charlie down in La Paz, Mexico, and we'll post that one for Charlie. You'll see that we've made a big butterfly pattern in Priceline up at this 1470 level. Whether that's going to be holding it or not, we'll wait and see. But there's also a large ABCD pattern in Priceline at that point also. So hopefully he'll take a look at that, and we'll see what it looks like. Okay, now we've talked about the divergences that we've seen in the stock market. We really need to take a look now at the emerging markets, because you hear more and more fact that we're starting a new bull market in the emerging markets. I've heard that several times over Bloomberg over the weekend, and I took a look at the EM chart, which is the ETF for the emerging markets, and I have a hard time believing this is a new bull market, because since August, all we did was make a 382 retracement, and there was a little 3-drive pattern there, and it's really has gone nowhere. We had the big head and shoulders pattern, of course, way back in June of 2015. And it certainly doesn't look like this is a new bull market. If we get above, 37, we're trading at 35 and change right now, then that could be, but that doesn't look like the case. The other one is looking at the Chinese stock market, which is the ETF for the Chinese market. And believe me, that's not an easy market to trade because it is manipulated by the government quite a bit. Today they announced they were going to allow the IPO markets to come back, and that made the markets for banking stocks go up the 10% limit and the brokerage stocks, but the rest of the stocks didn't quite do that well. So it doesn't look like a new bull market here in China. We've rallied 20% off the bottom, but that does not define, what the real market is doing from the perspective of what I'm watching anyway. And all I'm doing is watching the what the prices are of some of these things. So we'll just keep an eye on what's going on with them. But I don't believe that we have a new bull market in those. I mean, if you just look at the charts, I mean, the trend's down. I mean, boy, big time down. It's not just a little move down. These are big moves to the downside that we're seeing. So we'll have to wait and see. Now, we want to take a look at the gold and silver because this is one that I really thought we had a chance in silver and gold to hold these levels. The good part is that when we got up to that ABCD level in gold, we were certainly alerting folks to the fact that that was a big ABCD and wait for a correction. I thought that the 1130 area was going to hold, but in fact it didn't. As you can see, we've gone down and we've almost made a double bottom to where we were, back on July 27th. And you've got to give it some time here. It's very, very oversold because we've been down so many days in a row that it's extremely oversold. But you'll have to wait to see what quality of the rally we get, if we do get one, and then we'll see. But right now, it's hands off on the gold. I cannot be a buyer in here. Maybe it's the time to buy it, but I don't have any patterns or ratios here that even begin to tell me that we're in a potential bottoming area for gold. We could get one in a few days, but not right now. It's just not in the cards. Now, if we take a look at silver, silver's a little different because silver has we have a series of higher bottoms here, and there's a great deal of support at 1440 in silver. That's the 786 retracement. You'll notice that I put a 26-day cycle in here. That gives us higher bottoms all across here, so it's looking much better than the gold market. But the important thing about this chart is if you'll look at the high that we made back in silver back on October the 30th, when it hit a perfect 61% retracement, I mean almost to the exact penny. I think it missed it by 1 cent. Of the exact thing. I think the 1634 was the number I was looking at, and I think it got to 1635. So it was, pretty much spot on. And gold was already starting down. Gold didn't make a new high on that day. It made a much lower high, which told you that ABCD in the gold was probably correct. So this is also a situation that we're watching now in silver to see if this 26-day cycle, which will come in on Wednesday, the 11th, which is Armistice Veterans Day. So we'll see if that's going to hold that level. But 1444 is the number I would be looking at in silver, to see if it's going to hold. The open interest, as we mentioned several times, it looked like on the way down there was people leaving the market, so it looked like it had a bullish potential, but that certainly didn't happen. We had the same thing happen in the Treasury bonds, where we were seeing a lot of people leaving the market, which usually when the market goes down and open interest drops, that's a sign that the market is strengthening, and that has not been the case Treasury bonds and Treasury notes, and then also with gold and silver. So it just means that it could, go down a lot lower before it finally gets a bottom. So I can't see any reason here to be looking to buy gold or silver, and we'll see if we do get the thing, moving a little bit, and we'll see if that's going to be the case. We've had a pretty good. We went down and stopped right at the 61% retracement here in the S&P futures early this morning, and we're going to find out if it's going to hold. But it's still a little bit early in the morning. Now, for those of you that are interested in watching these Treasury notes and Treasury bonds, we're making new lows now on the long-term daily charts on the Treasury notes. There is a great deal of support at the 786 down here at the 125.21 level. So far, we've been to 125.22. And I believe that there's a chance here that we could hold this level, but anything below that, we're going to go a lot lower. But there are several numbers coming here in the notes at this 125.21 level. We're trading 125.23 right now. If we take a look at the euro, we've been very, very bearish this euro for a very long time, and we still think we're heading towards par. Of right around 99, actually going below par is what we're probably going to be looking at. And I will post this euro chart in here, and you'll see that on the long-term chart, it certainly looks like the euro wants to be heading towards this level of right around 99 is what it looks like. There's several big moves here. We had this little tiny ABCD move over the last 4 or 5 months that stopped up at the 117 level. We're now 10 handles below that, and it certainly looks like it wants to head towards that 98, 99 level on the long-term chart. This thing has been bearish since 2007, and I don't see any reason to change the scenario here. Has some pretty good rallies through here, and we are incredibly oversold. There's no question about that. But it's it still looks like it wants to go lower. We had a request to take a look at our crude oil of what we're watching here, and I still think these commodities just don't look very, very bullish, folks. That's the bottom line, and you'll see that there's a potential here of going back below $42 a barrel again. And we did rally over the last few days. We rallied up to the 61% retracement at $48. That sets up the ABCD pattern down here, just a little below 40 at 39.5. So, and below that, if we get below 37, there's not much down there other than $30 a barrel. And, this market just does not it just can't get out of its own way. And if you look at gasoline and you look at the heating oil, they're also confirming that these markets look like they want to go lower. I mean, gasoline in Arizona is under $2 a gallon. So it's gasoline's a lot cheaper than it used to be, which is a good way of increasing income. So we'll be able to take a look at that. Now, we've had a request to take a look at the Japanese yen. And the Japanese yen is at the proverbial moment of truth, in my opinion, because we have, and this might fit in with what we're watching in these things. You'll see here that the dollar yen has got up to the 123.30 level. And if you'll notice that there's a 786 retracement at that point. It's also very close to touching a 20-man line. Which acts as a fulcrum. If you go back and look at this thing, bottomed in January, and then we touched it again in May, we touched it again in July, and we could be touching it right now. So watch it kind of carefully in here, because this is completing an ABCD pattern. You can see that by the blue ABCD Thunderbolt that's in there. That would be about 40 pips higher from where we're trading right now, but there's a potential for that to be occurring at the very same time. So that's the thing that I'm looking at. Folks, I'll tell you what, I have not looked at so many charts over these past 7 or 8 days than I have in years. And I'm looking at stock charts too, because I don't look at stock charts that often. But when I look at them and I see these huge gaps that we have in some of these things, and again, it's only 100 and some stocks that are doing all this. The rest of the market is not doing it that well. So I just concerned that there might be something a little bigger out here. And if you look at that first chart that our good friend Jim Bartolioni sent in, that's a real negative chart, because the comparison between what happened in 2007 and what's happening now is very, very apparent. And the number of people that look at that type of chart, you can count on, you can count one hair on your head, because it's like a needle in a haystack. No one looks at something that's gone back, that far. That's the main thing that you're looking at here, is a similar pattern that you should be really paying attention to. Maybe it doesn't work, but should we ever go below the August 24th low, you'd be looking at something extremely different. So you want to watch that. Now, one other pattern that I wanted to mention to you, because you see sometimes these patterns work and sometimes you don't. But if you look at what happened to Win, just a few months ago, when we were, well, it's been a little bit longer than that. It was way back in March of 2014. It was making that same ABCD type pattern, a big butterfly pattern on the long-term weekly, and the stock has gone from 250 down to 52. And this is the type of patterns that when they hit, they're really spot on, and we're seeing them everywhere, folks. I mean, Google, Microsoft, all of them. I mean, they're just Amazon, and they've got these monster gaps. I mean, look at the gap in Microsoft. Give me a break, folks. Go back. Microsoft started trading in 82. And that's when the IPO came out for it. And I don't think you're going to find, there are going to be a few gaps in there because it was a new company, but you just don't find many gaps in Microsoft. It's a very widely held stock, and when you see it gap up 10% like we did on October the 23rd, that usually means a great deal. From my opinion, at least that's what I'm looking at. So we'll see how this thing comes out by the time we go. So we'll see what the market's going to do before the end of the day. But just remember, some of these things will pop up from time to time, and we'll be able to look at it. And we have another cross rate. That we're looking at, and that is the Canadian dollar. We've had some pretty good interest in the Canadian dollar here over the past few weeks, and we're right up. We're up in the area of the 786 retracement of this whole move here, and this could be an area where it could be an interesting spot to potentially go short up at that 133.25 level. So we want to watch that also very closely. Someone's asked a question about the VIX index. Frankly, Basil Chapman, who will be following me either right after me or later, knows more about the VIX, and he's forgotten more about it than I know, so I let him handle that. But the VIX has been a very poor indicator because there's just nobody afraid in the market. There is zero fear in the market. We can see that by the chart that John Murphy furnished us, that's showing that the market is incredibly overbought. And that doesn't mean it can't go higher, but it just means that it's overbought. All I'm looking at are all of these patterns of the major stocks, over 100 of them, and they're all completing these patterns. That doesn't mean they can't go a lot higher, which they can, but it's telling you what you're looking at. But the New York Stock Exchange Index telling a totally different story. 877-927-6648.
Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Directions Daily S&P Biotech 3 times Bull and Bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Catch the Money Masters as they teach you the art of mastering money when it comes to trading and investing. Next on TFNN.
Okay, folks, I'm going to end the show here with turn it over to Basil Chapman in just a minute, but I wanted to end the show with this New York Stock Exchange chart that we got from Jim Bartolioni. It shows the weekly chart. This is very similar to the chart that I posted to start the show, only my chart went back to 1997. What he's showing you here is the top from 2007 and where we are right now. And as you can see, there is a big similarity in these. If you'll just look at the ABCD pattern that has formed, they look almost identical. They also both stopped at the 61% retracement levels. So you want to pay attention to that, especially if we close lower this week. Because if we close lower this week, that would tell us that this pattern is probably correct. And the fact that the the New York Stock Exchange Index only spent 2 hours above the 61% retracement last week. I went in and checked that just to be sure, because I know it exceeded it by 0.00 one thousandths of a percent, but on a 10,000 index, that amounted to about 25 points, and so it did go above it for a little bit, but then it went back below it immediately. Remember, this is the largest of all of the indices that we have as far as its broadest participation. There's several thousand stocks of the most heavily traded and the most active stocks in the world. Their international stocks are in there also, along with U.S. stocks. So it's a very broad index that people watch. So keep an eye on that. That's the thing. A bad close today would be well, especially this week, if we get a bad close, you'd be looking at something that would be rather bearish, in my opinion, and especially when you stop and think that we're extremely overbought. We've been up 25 days without a serious correction, and that in itself is an outlier event. Remember that any market that can go down 25 days can go up 25 days. We've just seen that. But the overall completions of all these big patterns and these other indices tell us that we're very close. So that's it, folks. Live every day in an attitude of gratitude, and may God bless, and stay tuned for the master himself, Basil Chapman.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.